Welcome to your closing bell for the week. We're here with the legend, number 8480. Just using both your numbers here, Mark. But we have a great one for you. It is a new era, the race for tech supremacy. That is our focus this week's conversation. We'll obviously cover some other big news this week. We had inflation numbers. We had big news for Bitcoin. I'm gonna call you Bitcoin Boyer from now on
Bitcoin
because
Warrior.
you got your billions in Bitcoin.
I might
but
now.
yeah,
Yeah.
but we do have some great stuff for you. And again, we're always trying to be entertaining, insightful, and hopefully somewhat smart. But all jokes aside, we're excited to be here this week with you. So Mark, I'm gonna leave the boring bonds to you. Not that
Why do I get the
because
boring bonds? And you're going to talk about Nvidia? Seems
yeah,
so
yeah, the
wrong.
flashy tech stuff because I'm a flashy guy.
Yeah,
But
it's all right. You're flashy. I'm just kind of basic,
uh,
boring, boring warrior.
you're
Boring warrior.
boring
Don't start
boyer.
that. I'm right now. I'm salt, right? Salt, pepper. Now you're going boring boyer. That's going to be kind of that's not. Yeah, whatever. But I think this
Big,
boring borer. So speaking of that, so
yep,
let's talk about bonds, fixed
let's
income,
do it.
right? So
Yep.
today, we got the ag at 10-year treasuries at about 4% roughly in that area. We're actually
Mhm.
today's Friday, so we're yields are dropping a little bit today because we had some inflation numbers that look like again cuts are in the future, which is positive. So, in our commentary, we're talking about bonds, and there's a lot of reasons to be optimistic about bonds, especially if you think the economy is going to be slowing down. And
Mhm.
we talked about this at our year-end call and so forth. I think most analysts, most people feel like you know do we go into recession? That's the kind of the question, but we're definitely
Right.
whether we do or not. There's a potential slowdown, and in fact, in December, the Fed was super clear that they're done raising rates. Now, there could be that extreme situation if the economy picks up, if things keep moving faster. You could raise. They could be wrong, and that would be a shock to the markets. But basically, it looks like things are slowing down, and that the Fed is in line to cut rates. They're talking about. I think the market's basically factoring in about a six cuts in 2024, and not
Yeah.
that's really high. But if it got really, for a recession got deeper, if that actually happens and goes deeper, that's possible. So we'll see. I'm not sure we're that aggressive, but we do think it's that there's bottom line cuts are coming. And so how does that look for bonds? Well, a lot of people are sitting in cash right now. We talked about this before. There's a lot of money on cash that's getting good returns in T-bills and CDs. You can't argue with that. It's been great the last
Mhm.
year. I mean, first time in a long time we've had yields to work with. So a lot of that money just to be safe is, and then we had a bear market a couple of years, 2022, was pretty rough in the stock market. So a lot of people just like, hey, I'm out. I'm going to go to
Yep.
cash. I can get yield now. And that makes sense. Makes sense. But this is a big but. Going forward now, though, the math part of the bond market and how that all works really comes into play. If you're sitting on cash right now in T-bills or a CD at the bank, you're getting a good yield. But if in fact yields do come down, some are saying as much as 100 basis points, right, this next year, or 1%
Yeah.
this next year, that could be significant difference. Now you would, whatever you got your T-bill or CD, you're going to get your return. But if you keep it till maturity, you'll get that. But your reinvestment risk is on the other side
Right.
when you get to the end of that term. Yeah, you got your 4.5, 5% or whatever, but you're now going to be locked into rates at where they are when that matures. Makes sense, right?
Mhm.
So now you're 6 months out, and you're going to get a much lower, if it drops, a much lower interest rate. So how's that compare with owning some fixed income? Well, the question is, well, if you then took cash and put it into fixed income, say the 10-year aggregate, where
Mhm.
you're getting good yields. Right now, like I said, it's around 4%.
Yep.
So you're getting a 4% yield. That's great. And now, if and how it works, it's based on duration. If your 10-year, if you're in a bond fund per se that has an average duration, let's say 6% duration. So they're into some short-term bonds, but they also, they're in five-year bonds and different things like that. But the average duration of that portfolio is 6%.
Yeah.
You could basically say if it comes down 100 basis points over the next year, Van, we don't need to get into bond math, but bottom line is your capital appreciation equals sort of is your duration. So you
Yeah.
would get, we drop 100 basis points, you're in that fund, your fund's going to appreciate 6%, which is roughly the
Yep.
duration of that portfolio,
Yep.
on top of the 4% that you're already getting yield. So you're talking 10% return over the
Right.
next year
Yeah.
in a portfolio that has what, a third of the volatility of stock market,
Yeah.
volatility. So, I mean, really good, safe, solid return in fixed income, as opposed to just keeping your money in cash. So that's kind of that. And so that's not nothing new. Is a lot of, that's a building conversation in Wall Street. And so anyway, something that is really important. And what we're working on in portfolios is making sure we take advantage of a lower interest rate environment going forward. So
Yep.
important to look at again, see how much money you need in short-term cash, but get that other money into some good, solid fixed income securities so that you can benefit from appreciation that way.
I'm glad you mentioned that because I was just going to say, yes, like if you have short-term cash needs, you got dividend income, you got your income coming in, and then your cash that you need in the shorter term, keep that in money markets, take
Yeah,
advantage of the higher rates. But again, it's because you need it. If you don't need it, like you just said, make sure you start extending that duration because I mean,
yeah,
think about this. And I want to even think further of what you're talking about is, okay, so imagine you stay like, oh, I'm just going to stay in, an ultra short or short duration, bonds or money markets. We got 6 trillion in cash and money markets right now are just about there. When let's say you just say, I'm just going to stay there. The rates are great. Ah, they're going to be higher for longer. I'm good for now. You're just keeping your short-term mindset all of a sudden, when you're going back into your reinvestment risk, let's say you're reinvesting, you own a six month CD. In 6 months, the rates fall 100 basis points. Hypothetically speaking, you're when you go in and reinvest at a lower rate, you're like, oh no, now I want to go longer. Now I want to go longer duration.
yeah,
I want that total return. You've already missed out on
yeah,
so much of that total return
yeah,
even if you wait 6 months, when the Fed starts cutting, you're already starting to miss out on that total return. So the time to get your cash to work is now. We've preached it. We're going to continue to preach it. So
yeah.
great points that you brought
We
up
have,
there,
we
Mark.
have we have a window of opportunity in here, and I think as investors, you got to take advantage of that. So really important to look at your cash needs and make sure you get it in a situation where it benefits you the most, and if interest rates do drop like we think they can this year. So, and even if we're wrong, okay, let's just say even if we're wrong.
Mm-hmm.
Longer term, it'll eventually, it will play out. But even if you're wrong in the short term, um, your downside risk is really minimal. You might, if in fact rates go up,
Yep.
you know, uh,
Yeah.
50 basis points or something. Yeah, I mean, we still get our yield. We still get our yield in the fixed income. We might lose
Yep.
some capital growth in that. So maybe your return is 2%, which is not great. I'm not saying that's great, but the risk of losing significant amounts of money, even if it goes the other way, is not. I don't know. I just think it's a good
Yeah.
play. And to your point, is just thinking about where you are in your portfolio. How much money do you actually need in CDs and T bills? And
Yeah.
I've been a big T bill. I mean, I'm all for that. The
Yeah.
last number. It's just the point is
Mm-hmm.
now we're in a different cycle, perhaps, and that's where you have to look. Even with I think you mentioned. I just think, totally my opinion, but I think in this period of time, it's hard. I think it's best to try to find investments where you can get these higher yields, but with liquidity, the ability to get out when you want and make changes. In other words, not locking your money up for 6 months or a year, but
Yep.
having it in something like you mentioned, ultra short. There's some, we're using some investment vehicles that are T-bill like, but
Right.
are very liquid. Like
Yep.
I can get in and out of them on a daily basis. So
Yeah.
again, I think it's important to stay liquid and flexible in your portfolio management now, especially on the fixed income. So
Love it. That's great
good stuff.
wisdom. Great wisdom for our viewers and listeners here. All right, so I want to jump to inflation real quick because I want to end with tech. I think that's kind of the juicy and meaty portion of it. But I just want to briefly touch on inflation because we had the PPI, Producer Price Index, and the Consumer Price Index inflation data come out Thursday and today, this morning. So I want to start with the producer, right? I want to start there with the goods producing people. Let's talk about it. So year over year, headline PPI actually reached 1.8%, down 20 basis points from the previous reading. And it was below the analyst expectations, which is fantastic, right? So, again, cooling inflation starting on the producer side, which filters through to the consumer side. So, we should be seeing next month, hopefully, cooler readings, which we'll get to CPI in a second, which kind of reaccelerated a little bit. We can have a brief conversation about that. But headline PPI again, 1.8%. First below 2% in quite a long time. So this is fantastic news. But core PPI actually increased by 10 basis points to 2.5%. So again, you're stripping out the kind of more volatile sectors there. It's still a little warmer. Again, it's above the Fed's inflation gauge of 2%, but 2.5% will definitely take it at this point. It is the lowest level since February 2021, besides last month's figure. So again, just 10 basis point reacceleration off of the lows dating back to February 2021. So good news on that side.
Yep.
Let's go to the consumer, and I'll get your thoughts on this here. Consumer price index actually sped up a little bit. So inflation rate, again, that's what we call consumer price index, consumers spending inflation, risen to 3.4%. So that surpassed expectations by 20 basis points. And it's a 30 basis point increase from November's 3.1%. Now, core CPI also increased slightly to 3.9%. That's stripping out volatile food and energy costs. So again, it's below 4%, which is fantastic. Again, you look at history, right? In the last 90 years or so, inflation averages about 3.9%. So that core number's right on track. And then the headline, obviously, 3.4, not where the Fed wants it. So maybe higher rates for longer. If they're going to see if this trend continues, does it go up even from there? I think it's holiday season and spending in that way. The consumer was just trying to end the year on a strong note. Mark, your thoughts on that?
Yeah, I mean, all of this, Jason, for me, these are numbers that are coming out, and yeah, a little bit higher in some and lower in others. I think you got to think longer term and look at the trend. The trend is to the
Yeah.
downside, which I think ultimately,
Yep.
I don't see anything that's really upended the thought that the Fed has done hiking rates at the
Right.
current point. So anyway, good stuff there. I mean, I think that's what we got to keep our eyes on longer term in those numbers. I went to get gas today. Good news. I went to get gas this morning
It was
and
down.
you know uh, empty tank and filled up the car and wow, it's like, oh, nice. I mean, I'm a little less than $100,
Yeah.
and then we used to, just to it seemed like the last couple of years it's been 130 plus. So, I mean, I don't know. It's that's good news. And yeah, so I think it's in the right direction.
I agree. And again, we don't know exactly when the Fed's going to cut rates. Some people are pricing in March. At the March meeting, we'll get rate cuts. But again, it's going to be data dependent. Powell's harped on that from the beginning.
Yeah.
And also, I heard an interesting comment from a manager I met with yesterday afternoon saying, hey, the Fed doesn't like to raise rates within 90 days of the election. So your window to actually get the rate cuts that you're looking for is actually a lot smaller. So we might
Yeah.
get more aggressive rate cuts or with fewer rate cuts, or you might get, 10, 25 basis point rate cuts, probably 25 basis point rate cuts, in even increments or whatever. So
Yeah.
again, it accelerated a little bit. I think it's a holiday season, year end. We should see those numbers trend down these next coming months, but we'll keep you updated. But the main points we want to talk about today. So imagine this, Mark. Okay. You look at your digital calendar. Okay. You look at your digital calendar
I don't have a
You been
digital
playing?
calendar. Do I have a
Not yet.
digital calendar?
This is where
Maybe
tech's
that's
coming in, right? This is where we're gonna go with this here. So
right.
come along on this
Yeah,
journey. All
I'm
right.
old
So
school, bro. I still write things down on I still write things down on big yellow pads. You make fun of me. You know, it's just how it is.
no, you're pretty tech forward.
Yeah,
I
I'm,
can
I'm getting
appreciate
better. I'm getting better.
that. But so imagine your digital calendar one day, right? And you have a family trip. You're taking all of us to Bora Bora and those overwater villas. Just putting that out there
I
so
am.
we can do that. Yeah, this
Wow.
is in the future. We're just
Oh, okay.
forward planning. We're just putting
What's
into
Bora
the
Bora?
putting into
I
the
thought it was
sphere.
Bora. I thought it was Bora Bonds a little bit ago. Now it's
Bora
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 Bora.
Boyer. See,
How do
now
you
we
go
got a
from
third
boring
name.
bonds to Bora Bora?
Yeah. So we have
Anyway,
Bitcoin.
whatever. Go on with your example and your dream.
So yep, exactly. So this is my dream here, and there's method behind the madness. Okay, so digital calendar. You're like, hey, I'm gonna take the family to Bora Bora. So basically, you're gonna type into the computer um, dates you want to leave. It's going to link up with your digital calendar. It's going to search for the lowest airfare. It's going to look for the best hotel prices. It's going to monitor those. It's going to execute your order, send you the plane tickets, book your preferred window or aisle seat. Going to rent you a car if you need it, or set up airport transportation based off of your preferences that you've laid out in your generative AI little computer system. Okay. So
Is it going to
this is
work
where
out?
we're
Is
going.
it going to work out for me too?
Yep.
Okay,
No,
good.
that's one thing it can't do. Okay. It'll never be able to work out for you. But my point
Right,
being
right.
is we're in a new era, right? This isn't like the dot-com bubble. This isn't like cloud services when that kind of started off in 2008. That took kind of a decade to gain some traction because there was a lot of infrastructure that has to be replaced in that
Yeah.
sector. This is like moment by moment, real time change. So, again, just harping back to the point of like growth and innovation, there's no better place in the world than America to get that. That's why we love investing in American companies. But this AI space, it's a whole new beast. And there are a multitude of companies, a lot of the Mag 7 that we've talked about, that are vying for supremacy and to wear the crown of tech. So, one company I want to talk about is, of course, Nvidia. Looking back 5 years at performance of Nvidia, what do you think? What do you think performance wise Nvidia has done? Total return, not year by annualized performance. Total return in the last 5 years.
Oh, I should know this number, but I would say, well, wow. Let me look at the
Again,
chart
not
real
putting you on
quick.
the spot, just off the top of your head, like because people sometimes don't think
Uh,
about this. Just throw a number out there.
70%. No, that's
Five
too high.
year,
A
5 year,
five-year annual return?
no total return.
Oh, total return. Oh, what is it? 1,000?
Close. 1370,
1370.
1,370% total return over
Five
the
years.
last 5 years, NVIDIA. Most
Yeah.
of that did not happen until 2022. Okay. We
Yeah.
had a we had a nice little peak at kind of end of 2021. Obviously, markets had an incredible downdraft in 2022. Bond market did as well. Lots of uncertainty and crazy rising or crazy through the roof inflation. But I think the main thing is like Nvidia, they are the titan of semiconductors now. Okay. So I want to break down some numbers and get your thoughts on this and what you're kind of seeing as well. So if you even date back to a few years ago, 2018, majority of their business. So me as a kind of a tech nerd on the side, gaming, um, automation, things like that, that accounted. So like gaming chips. So like the computer chips that go graphics processing that go into gaming PCs, and obviously esports has taken off, whole nother subject. But NVIDIA's processors actually were like the status quo in the industry. Now
Hmm.
that accounted for a majority of their business was gaming. Um, well, actually, that number is falling incredibly fast. Just data centers, which are basically going to be able to house all of their hardware, software, AI. It's going to be incredible. So they're reaching nearly 78 billion in annual sales. They're projecting for 2025 just in data centers alone. That's a remarkable increase from 2 years ago, 15 billion. So their their revenue, just to put this in perspective and why we're talking about them. And again, we'll bring this back to like, so why are we talking about this? Their total revenue is expanding by 55% in the next fiscal year. That's the estimates. 55% in 1 year. It was 118% surge in 2023. 118% revenue
Yeah,
surge in
yeah,
2023.
crazy.
Another 55% in the next year. Again, just because you're able to basically add AI to software very quickly. If you have AI capabilities built into your hardware and your software, then you can make these changes real quick. And so it's helping their revenue. I mean, think about how many microchips are in cars from when you first started driving. Probably none,
Yeah,
right? When you started
yeah,
driving. Now
yeah.
I think there's
And we
gonna.
pedaled them. It was just a bicycle. There was no cars, horse and buggy. Unless you can call
uh,
them microchips. Maybe the horses had microchips in them, but I don't
yeah.
know.
Yeah. So I mean, but to the point of right now, there's going to be hundreds in a
Yeah,
single car.
they're
So
full
this
of
is not
horses.
going anywhere.
Yeah.
Um,
No,
any thoughts?
it's unprecedented kind of it's a renaissance. It's some people have called it you know a mega cycle for tech going forward.
Hmm?
We've it's a whole different deal, and you got to be invested there in some capacity if you're looking for growth. But this is a place that's going to impact both positively and negatively a lot of different places, and so I think, owning those stocks, yes, you've made a ton. There's lots of companies to buy in those spaces or around those spaces, but there's going to be a breadth of opportunities in all kinds of industries
Yeah.
from AI. That's why they call it a renaissance. And so it's going to be really fun to watch and fun to be a part of. I think, as I think about this, Jason, looking back years, went through the 1999 or late 90s, early 2000, kind of tech wreck. In those days, it was like anything that had a .com, name to it was basically going to be the next, incredible company. And so, but those companies had no earnings. And I think what
Yeah.
you're talking about and sharing with our audience
Yep.
today is like, these are legit companies that have legit earnings. So it's
Yeah.
not like, and the earnings potential is massive still going forward. So it's not
Yeah.
like it's not the 90s. It's like, Mark, this is it's people ask, is this good tech wreck? Doesn't look like it. And it doesn't mean they can't go down and they don't get overpriced. They're really
Right.
expensive, on a PE rate multiples. But the fact is, it's not like that period of time where it's just, there were no earnings at all. I mean, it was just all
Right.
hype. These will have its own type of hype in the markets, but yet at the same time, there's something behind it. I
Yes.
think the key will be to investing in the companies that and I know managers that we're using are really finding ways to look for opportunities from AI that are in places that nobody's thinking about, and that's kind of where you
Hmm.
want to be going forward
Yeah.
too. So kind of it's a incredible, like I said, it's going to be interesting to watch. And then the other side is the negative. I mean, there's a lot of, AI is going to cause job loss in lots of
Yeah.
industries, that can be now automated. I mean, there's some danger and some things around it that if it's hard to regulate, but it needs to be in lots of
Mhm.
different places. So that's a lot of
Yeah.
things that are out there with the AI's renaissance, I would say, or mega
Yeah.
cycle. It's going to be there's a lot of things still to play out, but Nvidia
Exactly.
is on the top of that whole deal, and it's amazing to watch that company roll.
So their value as of now is around the valuation's about $1.3 trillion, which is more than double to its closest chip making competitor. So
Yeah,
just shows you again, they've got the cash, they've got, which obviously and honestly, sorry, is it's a rising dividend as well. It pays a rising dividend, excuse my
yeah,
English, but which is great because they're rewarding their shareholders for investing in their company. And so they've grown the revenue, every year for the past 3 years or even past 5 years, to dating back to whenever they started their dividend. I don't have that off the top of my head, but it's really good. So very healthy, strong, sound company
yeah.
leading the way. Other ones, Microsoft, Apple, Meta, Salesforce,
The Mag 7, right? So a lot of them are
Yeah, there's a lot of
especially
great companies. Again, so we're
network.
saying you can own them, and we think you should be owning them because again, there's revenue, there's earnings to back it up. But again, just entry point wise, that's always the thing, right?
Yeah.
Don't try to time it, but in
Yep.
terms of what the perceived value is,
Yeah. Yeah.
get
Yeah.
in
No, a
when
lot.
people said it.
And I prefer, honestly, I would go back to the ETFs. You can buy them. I mean, I
Yep.
think we're active managers. And we use active managers that I really feel confident are digging into this in a deep way, talking to the
Yeah.
CEOs, the
Yep.
CFOs. I think that's really important because the the mob can jump in and do things based on not with a lot of information or knowledge.
Yep.
I think it's going to be really important in the years ahead to have people working for you on your team that actually have the knowledge, and have the ability to get the information and dig into these companies that you just can't Google and get what is I mean, is it a
Right.
bias? You know what I'm saying? Like you got to do your research. So
Got to.
we try to do, but also we realize that we're not prideful to think we have all the answers. There's a lot of smarter people than us, a lot of them, and the fact is we try to gain access to them and have them help us figure this out. So real important now, I think, going forward as investors.
Absolutely. Have a thoughtful approach to investing whenever you do. So, last thing we want to talk about real quick is the SEC, which is the Securities Exchange Commission, approved Bitcoin ETFs, approved 9 of them, I believe. So, the world of cryptocurrency has been a large talking point for a lot of tech savvy investors. There's been a lot of criticism over it, security concerns, centralization of it actually, which is a lot of people talk about it being decentralized. There have been avenues by which that has become not the case. Government seizing or taking control of certain assets. So that's always the battle. But overall, I think this is just going to open up the opportunity for investors to be able to get in,
Yeah,
and instead of having to physically own the Bitcoin or the crypto and utilize a wallet, a digital wallet, and keep key codes, passwords, encryption, all that kind of stuff, like where it's a lot more falls on you, where maybe security wise, it's not the strongest and can be stolen very easily. Um, and again, this is just a generalization there, but maybe this is a way for you to get in and test out the waters, put a part of the portfolio into this, and let the big dogs, such as Grayscale, who converted their Bitcoin trust, GBTC, which I think is the ETF symbol, but they now own the physical assets, so they became a
yeah,
spot ETF now. So let those big dogs encrypt, have the top Fort Knox style security, so you really don't have to worry about it. So again,
yeah,
always say be cautious with stuff like this. Again, it's the Wild West for crypto still. It's been a lot of run up. It's done incredibly well in terms of total return. But again, just words of caution, still be ready to lose the money because of the fact that it could fall out. I mean, we saw last year it was down over 75% at one point from its highs. Obviously, it's come back a ton,
yeah,
but
yeah. No, you nailed it, man. I've got clients in the GBTC, Grayscale Bitcoin. Those who are interested in this is kind of where I go for it. ETF, and yeah, I think it's still. We just talked about AI. I don't see, there's still jury's a little bit out on the Bitcoin deal, but with this information, it just opens up the opportunities for more people to gain access without having, like you said, to have the wallet. It's a good thing. Again, what's great about it's what's great about America and about
yep,
our system is that we have, they find ways for us to be able to invest, and you still got to
yep,
invest with wisdom and
yep,
with diversification and all those things,
yep,
because if you look at a chart, of Bitcoin, it's pretty volatile and
yeah,
has been, but doesn't mean, you know. So I think these new these ETFs, not really new, but these ETFs and uh, uh, this approval of this opening up just going to get more people involved, and which could be beneficial. It was interesting yesterday. Market, on Grayscale, popped up on the news, boom, over
yeah,
$40 a share, and then
Yeah.
Today it's pulling back 38, right? So again,
Yeah.
this thing's pretty dollar cost averaging. You can kind of read it like a stock in a way and
Yeah.
trade it that way. So it's interesting. Good stuff.
Yep. And I'm going to say one controversial thing to some of my tech clients or, crypto believers, Bitcoin believers. Again, if you think that the governments of the world are going to let you take their currency away and make this the currency, you're out of your mind. Okay. The US
Tell
dollar is
us,
not going
tell us what
away.
you tell us what you really think.
It's king dollar. It
Wow.
always the
Out of your
world's
mind.
currency. The world's
Yeah.
currency is still the king dollar. There are some efforts to take that down, but in the near term, there's no better country in the world than the U.S. In terms of economic stability and growth potential. Again, growth and innovation comes from America for the most part. Again, I'm not saying other countries are bad or whatever, but when it comes to like where we've come from and the ability to grow and innovate and really kind of achieve our God-given potential, America is the place. So that's why everyone wants to come, is because this is still the beacon on the hill. So I will just say that Bitcoin won't take the place of it. It's going to be think of it as an alternative. It's a way to potentially make money. Blockchain technology, which is behind all the cryptocurrency, is absolutely fantastic. I think that is a game-changing technology, which we can get into in another time. But really, just wanted to bring that home. Is
Yeah.
make sure your hopes are realistic, and make sure that you're thoughtful in your approach to that type of investing as well. And say, hey, if I make tons of money, great. We want you to make money, but you just got to realize what it is and what it isn't. Okay, so it's a currency play in terms of you're buying the fluctuation of the price. It trades like a stock, and if you can buy it low and you want to sell high, just like every other type
Everything
of
else,
asset.
right? Yeah. I mean, you can't keep
Yes,
spending
yes,
and that's the thing
100%.
that's the area and our government that understands that and doesn't, you know, yeah, just keep throwing money at, things that aren't done efficiently and aren't good. So that's my biggest concern is
Yep,
internal,
good point.
us screwing ourselves up.
Yep,
A lot of times in sports, you see that where you got a team that's got a lot of talent, got all the talent in the world, but they just can't get it together in the locker room and make the right decisions there. And that's kind of like feels like sometimes with us
yep,
in America. So right now we need to have leadership that gets more spendthrift on in our government. That's going to be important. So sorry,
yep.
went a
Good
different
points.
direction, but
Good,
that's my biggest
good
concern
points.
in regards to the
Great
dollar.
points. Yeah, you're right. There's
And then to
internal and
that point on the
external.
dollar, just real quick. So you didn't talk about, but in here, where it's global economy expected to slow.
Yep.
That's accurate. It's been that way for a while. It's been that way, and we see it happening. But just remember that a couple of things. One is the markets in those areas often will move ahead of the draw or the trough in GDP in each of the
Yeah.
what I mean is that just because those areas are looking to slow doesn't mean you shouldn't be invested there, okay? Because or
Good
have
point.
some type of because when and if they do bottom out and begin to move, the market will have already moved ahead of that period of time. So that's what I'm saying. So
Mm-hmm.
that on top of the dollar, what you're just talking about, dollars really dropped fairly not significantly, but it's had a drop in here since the
Yeah.
rates have come down. And again, that's a real benefit to holding international equities or bonds. If the dollar drops, your exchange rates change, and it's a added benefit to being diversified even globally. So that's our take on that too. All
Perfect.
right, thanks,
All right.
Jason.
Thanks, Mark. Always appreciate your wisdom and insight. We'll see you next week on the next edition of The Closing Bell.
Wow, that sounds so good. I like